Hello, everyone. Welcome to the weekly roundup. Today we'll cover interest rates, growth, and market sentiments. Hello, Ben.
Hi, Eva.
How's it going?
Going pretty good.
Yeah, we're entering into the best weather of the year.
I would disagree, but I'm happy for you for enjoying the
No,
weather.
no, it is fall.
It is fall. It's sad.
It's summer for you.
Yes. Yes.
Oh,
Love
no,
summer. Love
no,
summer.
definitely fall. We welcome it.
Lots of people do for sure.
Yep.
Yeah.
Okay, we're gonna start off with rate cut expectations. This increased dramatically in Canada and the US on the back of weaker job numbers.
hmm
How much easing should we realistically expect, and have the markets priced it in?
So it's great. Great question. I mean, I think that it's hard to believe that was Friday, last Friday, but yeah, we went with the view last Thursday when we recorded that they weren't going to cut this week in Canada, and then on the back of the week's jobs number, we saw it move up to 93% likelihood of a cut next week in Canada. So it looks like they're going to cut. There's been some revisions here and there. Some of the Canadian banks have revised back to 75 basis points in the last quarter. We're still waiting for an update from our economics team to see what they say on the back of this. But a cut in Canada is all but locked in now after that number. In the US, we were already highly likely that they were going to cut rates in the US next week. And so the odds of a cut stays pretty much 100%. They're going to cut in the US, but the odds of two cuts increase a little bit. I'd say that's probably not likely, but it went from 0 to 15% chance of a 50 basis point cut. So that did move up a little bit. But I'd expect that we see cuts from both central banks.
Okay. Canada's GDP contracted by 1.6% in Q2. This is the first negative reading in almost 2 years. Does this put recessionary fears back on the table, and will these rate cuts offer any relief here?
Mm. Yeah, so it's a good point and question. I think as we try to figure out economic numbers and what they mean again, and it seems like the data is much better now than it was maybe 2, 3 years ago, where we had the spike and come down. Seems much more consistent now, and it does appear and feel like we're in a bit of a recession now in Canada already. The employment numbers are obviously bad and GDP is bad. So the question is, what does the market do at this point?
Mm.
Some may argue that we're already in the recession, so nothing to worry about, especially if rate cuts continue. So, I mean, we're probably in one or have been through one, at least in Canada. That's what I would think with the most of the tariffs and such starting to moderate a little bit. A lot of the Canadian companies have registered for USMCA or NAFTA. So, the sphere of 30, 40, 50% tariffs on a lot of the goods has gone down to, it looks like corporations on average pay 5%. So we're probably seeing a lot of the pain that we need to see in Canada. Will it continue? It depends, I guess, on how we react from this point. But it does look like financial conditions are getting easier in Canada, which probably mean maybe we're getting to the later stages of it, at least from a temporary perspective. So lots to cover though still.
I mean, with this softening economic data, what do we expect will trigger a shift in sentiments in the markets? What is going to cause that correction?
Hmm. So economically, I think you're right. So I think the question is the market still attached to the economy? And
At
so
this point?
at this point, it's hard to know because the markets seem to be much more focused on money supply and financial conditions. So I think your point is valid that the economy is deteriorating. So far, the market hasn't cared too much, and we've continued to move higher. Volatility's back down to an all-time low. So, you know, something could tip it over. I'm not sure what yet, But I don't think it's the economy. I think it's probably something else that would tip it.
Okay. Gold is still rallying hard. What does this signal to investors, especially about market risks and, safe havens?
Hmm. Yeah, gold's an interesting one, right? Everybody hated it for a decade, and now it's back on the front page and shiny again for everyone. So, I think it's whether you love it or hate it, it's been a store of value for thousands of years, and likely to be the case. And so it's starting to get quite a bit more attention as the US continues to do what they do. There's much more interest in getting away from the US dollar. So there's a kind of a flight to, let's say an alternative currency, which would be gold in this case. And so that looks like it continues. Most of the major central banks are buying gold into this. So there is lots of scenarios that make it positive. I guess my fear on the other side is we've had a good run. So
Yeah.
I'm wondering if we get another big breakout on it. But there's a lot of reasons why gold is attractive now, and it is still under-owned. There is still lots of individuals and institutions that don't own it, so it may still have some more upside, but it's been a pretty significant move this year.
Okay. That's the chart.
I know when it's there.
Yes, all good.
Okay, super. So, as usual, we are recording on Thursday around 1 o'clock, September 11th. And this obviously historically has been an interesting day, a long, long time ago now, 24 years. Um, so, just to update, going to talk a little bit about rates and inflation at this point. Yeah, so that this is after the jobs numbers on Friday last week, so 92% chance. We see this, so this is likely to happen in Canada, 100% chance in the US. I think what's more interesting is they do provide significant guidance on where rates are going. And so this would be for every 25 basis point cut. So you're looking about three cuts this year. You're looking at, we'll say, five by the end of the next 12 months. So that would be about 130 basis points or so, roughly at 5.4. So pretty material softening financial conditions. Chair Powell is in the chair till May unless something happens between now and then. So the likelihood of rate cuts continues to crank up, particularly in the US. And so we'd be watching that quite closely at this point. This is another piece that I want to and continue to follow is gold as rallying, obviously, and commodities, oil and gas is falling. So as oil moderates around here, there's two ways to look at it. One is a weakening oil price actually gives the consumer more money in their pocket, so this is good for financial conditions. And gold continues to rally, maybe as a fear, maybe as momentum. But this divergence I continue to watch as something to be conscious of what's happening in the markets and the economy. Next one is just on forward forecasts. We haven't revised our numbers just yet. So this was of the recent data. So we're expecting right now 50 basis points. I'd expect after the jobs numbers, when we revise our numbers, we would likely see 75. And then as you look at the 2 and 5 year, I think these are important numbers because they have an impact on what happens in the mortgage market in Canada. So if you're looking at a 2 year fixed mortgage, you're around 2.4 there. On the 2 year, you're looking at somewhere in the neighborhood of three, 3.5 on a fixed mortgage. So interesting number to be conscious of. Then we anticipate markets and the economy to reaccelerate next year, hence the move of higher yields in Canada. So and be conscious of these numbers and continue to watch it and pay attention. Great chart from Charlie Belilo. He does excellent research, but I think this is a great way to look at the forward curve from the what's going on with the US, FOMC. So this looks like softening financial conditions for the foreseeable future. Is the market right? Not always, but it's an important thing to think about when you're trying to decide what happens to the market. So the economy is one thing, but what happens to the market is the other thing. And liquidity and financial conditions have been major drivers relative to the economy in the last decade and a half. So this would be an important chart to pay attention to. Ultimately, easier financial conditions, rates are going down. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. If you do have any questions, please contact myself or your advisor. Happy to discuss your risk tolerance as it's not equally applied to all people. And that's it for the charts today.
Oof. Thank you, Ben. What's on the agenda for next week?
Yeah, so certainly next Wednesday will be when the central banks meet, Canada and the US, and we can look at rate cuts. Everyone loves to watch the Fed presser at 2 p.m. on Wednesday, so we'll be watching to see what Chair Powell, 2:30, sorry, has to say. They'll parse what the words are, what are they saying, how is it reacting. So I think that's one of the biggest things that we'd be looking at next Wednesday is what are they saying, what do they mean, what's likely to happen. I've had a number of questions. What's the Bank of Canada doing? I think next week we'll get a better picture for that. Are they going to cut rates and at what pace? And do they decide to push the yield curve down by buying bonds in the 3 to 5 year range? So those would be a couple of things that I'd be looking at.
Okay, great. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats newsletters will be in the caption of the video and in your email box. For our clients, please reach out to me if you'd like to schedule a meeting with Ben or if you have any questions. Thank you, everyone, for listening and enjoy the rest of your day. Bye.
Thanks, everybody.